Okay, so good evening to all the students. Let's continue with our chapter of investment decisions. In the last two sessions, we have covered 6 capital budgeting techniques: payback period, discounted payback period, accounting rate of return, net present value technique, IRR technique, and profitability index or desirability factor. So hope you have revised those capital budgeting techniques. And today we are going to start with the last technique of capital budgeting. The last technique of capital budgeting called modified IRR. What is the name of this technique? Modified IRR. And in short terminology, it is written as MIRR, MIR. Okay. So it is first of all, it is an advanced version of IRR. See, NPV technique and IRR technique, the normal NPV technique and the normal IRR technique has one inbuilt assumption. Each technique has one inbuilt assumptions. What is that inbuilt assumption of NPV? The inbuilt assumption of NPV is the cash inflows that are generated every year, that are generated every year are reinvested at discounting rate. This is what NPV technique by default assumes. What do you mean by reinvested? See, each year project would generate cash inflows. Year 1 cash inflow, year 2 cash inflow, year 3 cash inflows, and so on till the life. Yes or no? Now, practically and logically think, will the company keep that cash inflows in the pocket or in the bank account as it is? Obviously not. The cash inflows that each year is generated obviously will be reinvested. Yes or no? The cash inflows each year that are generated by the project, obviously they will be reinvested somewhere. So the NPV technique assumes that reinvestment would be a discounting rate, and IRR technique on the other end assumes that it is reinvested. The cash flows are reinvested at IRR rate. Are you getting this? The cash inflows that company earns each year from the project, obviously they will not keep in the pocket or in the bank account. They will reinvest that cash inflows. Are you getting this? So NPV ka by default assumption is it is always to be reinvested at discounting rate, whereas IRR assumes that all the cash inflows generated are reinvested at IRR rate. So my question to you, which of this assumption is more logical? NPV का assumption is more logical or IRR का assumption is more logical? My question to you all, which reinvestment assumption is more logical and practical? See, think IRR is that rate which gives you the maximum earning capacity of the project, and NPV is that rate which generates the desired rate of return, which generates our desired rate of return. So now tell me, which reinvestment assumption is more practical? NPV. Yes, NPV. Some of you said IRR. No, obviously NPV. Why? Because IRR is telling about the maximum earning capacity of the project. Anything can be maximum capacity. I'm not concerned with that. If I'm getting my desired rate, if I'm getting my expected, I'm done. I'm satisfied. So NPV ka assumption is more logical. Are you getting this? So modified IRR, as per modified IRR, it is advanced version of IRR, and it removes this deficiency. Modified IRR. See, the steps involved in modified IRR is: first, calculate the cash inflows. Then modified IRR says that the cash inflows that are generated each year by the project will be reinvested at discounting rate, because we are concerned with our expected, our desired rate of return. So it should be reinvested at discounting rate. Are you getting this? And we have to reach at a terminal value. What is the terminal value? See, मैंने कुछ नया word बोला, terminal value. What is that terminal value? Terminal value means life of the project, end of the life of the project, end of the term, end of the life. So let's say project life is for 3 years. Let's say project life is for 3 years. Okay? And my cash inflows of year 1, of year 2, of year 3 are something like this. See, understand this very carefully. Yeah? Understand this very carefully. These are my cash inflows ka pattern for 3 years. Now, what will company do logically? Company will not keep this cash inflows generated idle in its pocket or bank account. It will reinvest. It will reinvest. But at what rate? It will reinvest at its desired rate of return, at its KO, at its discounted rate of return. Yes, useful life as terminal life. The last period of the project, the last year of the project is called terminal value. Means now we are reaching at the terminal point. Okay? That is. So what will company do? Company will reinvest this 50,000 for another 2 years. Yes or no? Company will not keep this 50,000 idle. It will reinvest this for another 2 years. Are you getting this? Similarly, company, the cash inflows that are generated in year 2 will not be kept idle with the company. Company will reinvest this for another 1 year and will reach at a terminal value. Are you getting this? And 250 is already at terminal value. Are you getting this? Company will earn 50,000, will generate 50,000 at the end of year 1 in the form of cash inflows. Now company will not keep it in the pocket. It will reinvest for another 2 years at the discounted rate or at your desired rate or company's expected rate or industry rate. Are you getting this? So 50,000 will be reinvested for 2 years. Yes or no? So in that case, 50,000 will be reinvested for 2 years. So I will get some cash inflow. This is called terminal value cash inflow. Similarly, 1,50,000 will be reinvested at some rate, at the discounting rate or at my desired rate for another 1 year. So I will generate some additional cash inflows at the end of year 3. That is called terminal value cash inflow. And 250 is already at the terminal value. Okay? So it is already at the terminal value. So can I say at the end of year 3, company would be having one pool of cash inflow called terminal value cash inflow. At the end of year 3, company will be having one pool of cash inflow. That is called terminal value of cash inflow. Hey, any queries still here? Are you understanding what modified IRR is trying to say? Share my screen again. Is everyone following? NPV and IRR not understanding. You have not understood NPV and IRR technique. So for that you need to revisit to the earlier session and understand the concept. It will be at the end of the project value only. It will be at the end of, see, 50,000. Can I say I will invest for another 2 years? So can I say present value is 50,000? I will invest at another 2 years. So can I say this will be my cash inflow at the end of year 3? At the end of year 3. Similarly, 150 of cash inflow generated in year 2, at the end of year 2, will be reinvested for one more year. So can I say this amount again will be cash inflow at the end of year 3? And 250 is already at the end of year 3. Are you getting this? You will understand once we take some practical problem. Once we take some practical problem, you will understand that. But modified, to remember, you just need to remember as of now that modified IRR says that cash inflows that are generated each year would be reinvested at discounting rate. Are you getting this? Let's take an example and get some better clarity on modified IRR. ठीक है? Please open module का page number 43. Module का page number 43. Illustration number 9. An investment of 1,36,000 yields the following cash inflows. Determine MIRR considering 8% as a cost of capital. My discounting rate is 8%, which is given in the question. Now see how MIRR works. My cash outflow is 1,36,000. The initial investment of the project is 1,36,000. Yes or no? Now see. Year. What is the life of the project? It is for 5 years. It is given in the question. 4 and 5. My cash inflows per annum. My cash inflows per annum are 30, 40, 60, 30, 20. 30,000, 40,000, 60,000, 30,000 and 20,000. Okay. Now, whenever problem is on modified IRR, first step is to bring all these cash inflows at terminal value. First step is to bring all the cash inflows at terminal value. And what is terminal value? Terminal value means last year of the project's life. Means in this case, year 5 is the terminal value. Okay, so what do I mean by bringing all these cash inflows to terminal value? क्या सिर्फ यहाँ पे ऐड करना है 20 plus 30 plus 40 plus 60 plus 30? No, not this way. You don't have to just add it. Are you getting this? You have to think this 30,000. If I invest for further 4 years, then how much would be the value of this 30,000 after the end of 4 years? Are you getting this? You just don't have to add it in absolute terms. See, this 30,000 company has earned in year 1. Okay? Now company will not keep these funds idle with it or in its bank account. It will reinvest. And at what rate it will reinvest? So modified IRR says it will reinvest at its desired rate of return, at company's wish, at company's expected rate of return. And if it is not given, then at the industry rate. And that is also not given, then at cost of capital, at discounting rate. Are you getting this? So you have to bring all the cash inflows to terminal value. Are you understanding? Did you understand till here? Our task is to bring all the cash inflows. We have to bring this 30,000 to year 5. We have to bring this 40,000 to year 5. We have to bring this 60,000 to year 5. We have to bring this 30,000 to year 5. Are you getting this? But 30,000 at the end of year 1 will not be 30,000 at the end of year 5. It will something more because we are reinvesting this. And from that reinvestment, we will get some returns. Are you getting? Are you understanding this? Are you understanding step 1? Everyone? Yes, we have to bring the present value of 30,000 to future value. Okay? So step 1 under modified IRR. Let's go step by step and let's note down all the steps. Step 1. Bring all the cash inflows of each year to terminal value. And terminal value means last year of the project, last year of project's life, of project's life. ठीक है? So can I say this 30,000 that I have earned at the end of year one, I would reinvest this at 8% for another 4 years? Yes or no? This 30,000, I would reinvest this for another 4 years, means 30,000 plus 8% plus 8% plus 8% plus 8%. So my 30,000 ka at the end of 5 years would be 4814. Yes or no? This is present value 1 plus r raised to n. I will get future value. I want to find the value at the end of year 5. ये 30,000 का at the end of year 5 कितना होगा? Are you getting this? It is just the concept of time value of money. Understood everyone till here? Yes, correct, Kasak. Correct, Kasak. Kasak's understanding is very correct. I hope you know how to calculate 1.08 into 4 raised to 4 in Calci. You take 1.08 in Calci, you multiply, you press the sign of multiplication and you press equal to sign 3 times. 1, 2, 3. Okay? Since the power is 4, you press equal to times 3 times. When the power is 5, you press equal to sign 4 times. When the power is 6, you press equal to times 5 times. I hope you have learned this at lower level. Multiply by 30,000. So it comes to 4815. Hey, everyone understood this? 4815. Everyone is getting this amount? Yes, correct, Preeti. How to do in calculator? This was taught you at CA foundation level, but again I will repeat. When the power is raised to 4, first you take 1.08 in Calci, press multiply sign. Now since the power is 4, you press equal to times, you press equal to sign 3 times. 1, 2, 3. And now multiply it by 30,000. Okay, so 4815. Everyone? Everyone? Can I move ahead? Can I move forward? So this is, so can I say this 30,000? Can I say this 30,000 will be equal to 4815 at the end of year 5? Yes or no? This 30,000 is 4815 at the end of year 5. Similarly, we have to solve it for 40,000, 60,000, 30,000 and 20,000. So can I say my 40,000, the cash inflows that is generated in year 2 will be invested for another 3 years at 8%? Yes or no? So again, take 1.08 in Calci, press multiplication ka sign. Now since the power is 3, you press equal to sign 2 times. 1, 2. Multiply by 40,000. So my present value comes to 5388. Yes or no? So my 40,000 that I have generated at the end of year 2 will be equal to 5388 at the end of year 5. Hey, are you getting this? Is everyone following? Any questions still here? सिर्फ हम present value से future value पे आ रहे हैं. We are bringing all the cash inflows at a terminal year, at a terminal point. Follow any queries? I'm going very slow. Hardik is clear. Preeti is clear. Can I go ahead? Can I solve it for year 3? So 60,000 at the end of year 3. The cash inflows that I have generated at the end of year 3 will be invested for another 2 years. So it comes to one again. Take 1.08 in Cal C. Press multiplication ka sign. Now since the power is 2, you press equal to sign only one time. Okay? Multiply by 60,000. So it comes to 69,984. So my 60,000 ka cash inflow will be 69,984 at the end of year 5. Are you getting this? 30,000 of cash inflow generated at the end of year 4 will be reinvested for another year. So 30,000 into 1.08. It would amount to 32,400 at the end of year 5 plus 32,400. Are you getting this? So this 30,000 became 32,400. And this 20,000 at the end of year 5 will be 20,000 only. Yes or no? 20,000 at the end of year 5 would be amounting to 20,000 only. So can I say my terminal value cash inflow is sum of all? This is my terminal value cash inflow. I am bringing all the cash inflows at a terminal point. Are you getting this? Understood till here? कितना हो रहा है? 213,587. Yes or no? 213,587. Understood till here? Yes, correct. Everyone, modified IRR का step 1, bringing the cash inflows each year to terminal value. To terminal value. Sir, the value of 100 in past year will be less this year. Here the future, here the FV is increasing. We are going from present value to future value. We are not coming from future value to present value. If we are coming from present future value to present value, then value will decrease. But we are going from present value to future value. Let's say if I tell you to invest 1 lakh today, and after 2 years, let's say I tell you to invest 1 lakh today for 12% for 2 years. So can you tell me what is the amount after 2 years? What is the amount that you will get after 2 years? You invested 1 lakh today at 12% for 2 years. What you will do? 1 lakh plus 12% plus 12%. So 1 lakh का हो जाएगा 125,440. So that is future value. See, we have not discounted anything yet. We have just gone from present value to future value. Yes, 125,440. तो वो क्यों बढ़ा? वो क्यों बढ़ा? कम होना चाहिए ना ऐसा. This should be your question. But it is logical. You are going from present value to future value. आज 1 लाख invest किया है. Today I have invested 1 lakh. So after 2 years, obviously it will increase my value of investment. ठीक है? So first step is to bring all the cash inflows each year to terminal value. That is the last year of the project's life. So our first step is done. We brought all the cash inflows. We brought all the cash inflows each year to its terminal value. That is last year. So can I say now my cash inflow is only at the end of year 5? Yes or no? Think logically. 30,000 I earned from the project, I reinvested till the end of life. 40,000 I earned in year 2, I reinvested till the end of life. 60,000 I earned at the end of year 3, I reinvested till the end of life. So likewise, can I say now my amount at the end of year 5 would be 213,587? Yes or no? I have pulled all the cash inflows to terminal value. Now my amount at the end of year 5 would be 213,587. So the modified IRR rate, see, IRR rate is that rate where PVCI is equal to PVCO, correct? Modified IRR rate says that your PVCI at terminal value should be equal to PVCO. Are you getting this? IRR says the PVCI, the present value of IRR is the rate where PVCI, present value of all cash inflows, is equal to present value of cash outflows. But MIRR is that rate where PVCI at terminal value, or I would say present value of cash inflow at terminal value, is equal to present value of cash outflow. Are you understanding? This is little complicated and modified IRR is little complex. First step, you need to understand step by step. First step is bringing all the cash inflows to terminal value, to terminal point, and terminal point is the last year of the project's life. That first step we have done. Okay? Now it is similar to IRR. IRR was that rate, was that discounting rate where present value of all cash inflow is equal to present value of cash outflow. MIRR is that rate. It would be that discounting rate, is that discounting rate where present value of terminal cash inflow, present value of terminal cash inflow is equal to present value of outflow. So can I say terminal cash inflow here? Present value of terminal cash inflow is 213,587 is equal to present value of 136. MIRR is that discounting rate which equates the present value of terminal cash inflow with present value of outflow. Are you getting this? Understanding? So again, we will use trial and error method. We will use trial and error method. Okay? Let's take trial 1. Let's take, see, now my cash inflows. Understand very carefully. Now my cash inflows, I have to discount only for the year 5. I have to discount only for the year 5. Why? Because I have brought all the cash inflows each year to the terminal point. I have brought all the cash inflows each year to the terminal point. So now my task is just to discount this one stream of cash inflow. Now my task is just to discount this one stream of cash inflow. So let's take trial 1 at 10%. Let's take trial 1 at 10%. So can I say my present value of terminal cash inflow, my present value of terminal cash inflow would be 213,587 divided by 1.1 raised to 5. Yes or no? Now I am discounting the cash inflow, that pool of cash inflow at the end of year 5 at today's point. ठीक है? So कितना आ रहा है? 213,587 divided by 1.1. कितना आ रहा है? Everyone please calculate. 136 is given in the question. 136 is outflow that is given in the question. Please read the question. An investment of 1,36,000. 284 ये कैसे आया? What is 284? 132,620 correct. 132 620. This is my present value of terminal cash inflow, and if I subtract present value of cash outflow, which is how much? 136. So my NPV comes to negative 3379. Yes or no? But I want at IRR, at MIRR, I want NPV to be 0. I hope you remember that. Huh? Hope you remember IRR technique. We used to take different trials, and using interpolation, we used to calculate the rate where NPV comes to 0. So वही यहाँ पे करना है. We have to repeat that same process again. 3380 negative, correct. So can I say this cannot be my MIRR because NPV is coming negative. I want NPV to be 0. So can I say to bring this up from negative 3379 to 0, I need to decrease my discounting rate, because lower the discounting rate, NPV will increase, and higher the discounting rate, NPV will fall. This is what we have learned last lecture. Correct? I have to bring my NPV from negative 3379 to 0. So I have to increase my NPV in technical terms. So to increase your NPV, to increase your present value, you need to reduce the discounting rate. Okay? You need to reduce the discounting rate. So trial 2. Calculation of NPV when discounting rate is equal to 9%. Or let's take a gap of 2. Let's take when it is at 8%. Okay? So again, present value of terminal cash inflow. Present value of terminal cash inflow. Now the discounting rate is 8%. 213,587 divided by 1.08 raised to 5. कितना है? 213,587 divided by 1.08. 145,363 364. 145,364. Correct? And if I subtract present value of cash outflow, which is 136. So can I say my NPV is now positive? 145,364 less 136 plus 9364 plus 9364. Everyone understood till here? This is little complicated. MIRR is little complex. You need to understand step by step. Step 1 was very simple. Bringing all the cash inflows each year to the terminal point. And terminal point is that point which is at the last year of the project, which is last year of project's life. So we brought all the cash inflows and pooled it till the terminal point. Now the discounting rate, which equates, listen very carefully, the discounting rate which equates the present value of terminal cash inflow with the present value of cash outflow is MIRR. So again, to calculate IRR, we will follow the same principle of interpolation and trial and error method. So we are doing same thing here. Okay? So at 8%, again by interpolation. By interpolation also you can solve, or by applying the formula also you can solve. Okay? When my rate was 8%, my NPV was positive 9364. When it increased to 10%, my NPV became negative 3379. Are you getting this? So increase of 2% is resulting in decrease of NPV by how much? Can I say 9364 plus 3379? It is leading into decrease of 12,743. Sir, कैसे 12,743? This is positive 9364. So first it will fall till 0 and then additional 3379. Are you getting this? So by increasing the rate of 2%, it resulted into a fall of 12,743. But I just want my NPV to fall by 9364. Why? Because I want to bring at 0 point. I want to bring that amount to 0. So by how much percent I need to increase the rate? So you need to do interpolation. That is nothing but simple cross multiplication. 9364 into 2 divided by 12743. कितना आया? कितना आया? बोलो. What is the answer? 9.46. Yes. Correct. 8 plus 1.46 equals to 9.46%. So this is my MIRR. Everyone understood? Everyone understood this? How to calculate MIRR? And by formula, we can also solve by formula. MIRR follows the same formula of IRR. Lower rate plus NPV at lower rate, the whole upon NPV at lower rate minus NPV at higher rate, multiply by higher rate minus lower rate. So we can use this formula as well. 8% is the lower rate. NPV at lower rate is 9364 divided by 9364 minus NPV at higher rate was minus 3379, multiply by higher rate was 10, lower rate was 8. So you will again get the same answer. ठीक है? बोलो, any questions? Exact 9% because of that rounding difference. So this 9.46 is also correct. You don't need to worry in that. We have taken entire amount in our calculation. We have not rounded off anything. Understood the concept of MIRR? Any doubt? Any queries? So step 1, let me mention each step. Again, I am quickly revising MIRR. Step 1, bringing all the cash inflows each year to its terminal point, and terminal point is the last year of the project's life. Now after this step 1, step 2, follow the process as you follow for IRR. As you follow for IRR. That is, you need to use trial and error method. And MIRR, lastly, is what? It is that rate where present value of terminal cash inflow, present value of terminal cash inflow equates your initial investment. यहाँ पे under MIRR there would be only one pool of cash inflow, and that is, it would be at the end of the project's life. So you need to just discount the one pool of cash inflow, the entire pool that would be at the end of project's life. Understood? MIRR. Bolo, any queries? Any queries? Clear? Okay. Yes, I just revised the step of MIRR. Someone asked me, Pranjali asked me to revise step of MIRR. So now it is clear to you, or shall I revise it one more time? Pranjali, please respond. You want me to revise it one more time? Because I just did it recently. She's not responding. Okay, let me revise it one more time. Step 1 of MIRR, bringing all the cash inflows to terminal point. Terminal point is the last year of the project's life. Once that is done, it means in the back of the mind, in the back of your conscious, you need to understand that you have brought all the cash inflows and you have created a pool of cash inflows. You have created a pool of cash inflows, and there would be only one cash inflow at the end of the project's life. That entire pool would be one cash inflow at the at the end of the project's life. Okay. Then second step is to just follow the process of normal IRR. That is, use trial and error method and find that rate where your terminal value ka cash inflow equates your initial investment. Sir, one clarification, please. All the present value of cash inflows are estimated or actual incurred. A cash inflows are not incurred, they are earned. Incurred expenses are incurred. Inflows is profit, they are earned. Dishika, I cannot discuss. If time permits, I can discuss IRR process, but I need to move for I need to move ahead with different concepts because still there are many concepts to be taught. So if you want to quickly revise IRR, you can either attend a revisionary lecture which is on 12th or and 19th for this chapter, or you can see the recorded lectures of previous sessions. 213587 divided by 1.1 raised to 5, it is normal discounting. I hope you by this point in time you know how to do discounting. To take 213587 in your calc, press division sign, press the division sign, press 1.1, and since the power is raised to 5, you press equal to 5 times. 1, 2, 3, 4, 5. It comes to 132, 620. By now, you should know how to calculate discounted value in calc, how to calculate future value in calc. This was taught at lower level. Okay, let's move ahead now because we are in short of time. Now, next concept. See, all the techniques are done. All the capital budgeting techniques are done. But there are certain other topics that we need to cover in this chapter. So other topic is there are certain conditions or certain criterias where there are certain criterias where IRR and NPV will give conflicting results. There are certain situations, or I would say criteria, where IRR and NPV will give conflicting results. What do you mean by conflicting results? So let's say there are two projects, ठीक है, mutually exclusive. Project A, Project B. Project NPV of Project A is, let's say, 10,000 and of Project B is 5,000. So as per NPV technique, when the projects are mutually exclusive, can I say my finance manager will select Project A because it is generating more NPV? But on the contrary, IRR of project A is, let's say, 15% and of project B is 17%. So when I say as per IRR technique, project B is selected. So can I say NPV and IRR are giving conflicting results? Yes or no? Are you understanding this? So what are the different situations where such conflicting results arises that we need to learn now? Understanding कि as per NPV project, decision is project A, selection is project A. But if we see as per IRR technique, decision or selection is project B. So under what situation such conflicting results arises that we need to learn now? So there are three different situations. So there are three different situations where such conflicting results, conflicting answers between NPV and IRR would arise. Perfect, Hardik. I was about to come to this point, but you already answered it here. So when such conflicting results arises and you are asked to choose between one of the projects, so in that case we will always prefer NPV technique. And practically also corporates go or give more weightage to NPV technique because NPV technique ka assumption is more logical. But here our task as of now is to identify the different situation or to learn the different situation where conflicting results arises. Okay? So situation first situation is when the size of projects are different. When the size of projects are different. What do you mean by size? What do you mean by size? The example is, let's say project A ka investment required is 150 and on the other end project B ka investment required is 6 lakh. Project A initial investment is 150. The investment required on the contrary in project B is 6 lakh. So when I say the size of the project is different, so under this situation, NPV will give different answer and IRR will give different answer. For that, if you want to see, you can see illustration number. See on page number 9, on page number 45, point number 9.7. Can you see on the screen? Different conclusion in the following scenarios. Okay? So first is scenario 1, when there is size disparity, when the size of the project is different. So they have given an illustration to it. Suppose there are two projects, projects A and project B. The cash inflows associated with the project are as follows. Project A, a negative 1 lakh. Negative means outflow. Negative means initial investment. So the size of the project is 1 lakh for A and size of the project B is 3 lakh. 3 lakh is initial outflow. That bracket means negative and negative means outflow. Okay? So by now you know how to calculate NPV and you know how to calculate IRR. So I'm not solving that, but instead just going on the end result. Because by now I have taught you how to calculate NPV and I have also taught you how to calculate IRR. So I'm just going on the end result. See the end result. The overall position is NPV of project A is 25,000, whereas NPV of project B is 59,300. Can you see this? Whereas IRR of project A is higher and IRR of project B is lower. So can I say there is contradictory results between the two methods, between the two techniques? Are you understanding? Right now, we are learning just the situations, the different situations where conflicting result arises. And as I told you, if question asks you to select one of them, then we will prefer NPV technique. Okay? Because we are more concerned with our desired rate of return rather than what project is having maximum capacity. See, IRR is represents what the maximum earning capacity of the project. It can be any damn thing. We are more concerned with my desired rate, with my expectation. Understanding? But right now we are just discussing the situations. We are not making any decision. Bolo, any queries in the first scenario? Any queries in the first scenario? Why we take NPV? I just explained. Because NPV discounts the cash inflow at my desired rate, my expected rate of return. Companies wish it discounts at the rate of the company's wish from the project. Whereas an IRR shows the maximum earning capacity. And maximum earning capacity can be anything. I'm not concerned with that. I'm concerned if it fulfills my expectation, if it generates my desired rate of return, I am done. Okay, so that's why NPV, and practically also all the corporates who conduct feasibility study of projects, they prefer NPV technique. They give more weightage to NPV technique because I have been into this field. I have been working in a finance role of one of the blue chip company. My task was just evaluating these different proposals, and we give more weightage to NPV technique. Okay, so this is scenario 1. Scenario 2, second situation. Second situation, when there is timing difference in generation of cash inflows. Timing difference in generation of cash inflows. By this, I mean that one project generates cash inflows at initial years. Starting में ही हो जाते हैं सारे cash inflows. Major cash inflows of the project are generated at the initial years. For another project, major amount of cash inflows are generated at later years. Are you getting this? So in such timing difference, there would be contradictory results. There would be conflict in the result between NPV and IRR. One project generates major cash inflows at the starting itself. Another project generates more cash inflows at the later years. So in that case also there would be timing difference. That case also there would be conflicting answers, conflicting results. So scenario 2 is time disparity in cash inflows. And what do you mean by time disparity? What do you mean by time disparity? The timing difference. One project generates cash inflows, major cash inflows at the initial years, at the beginning years, at the starting years, whereas another project is generating major cash inflows or larger cash inflows at later stage of the project. So see illustration number 11. They have proved all their points in the institute module. You can revise this after the end of the session. You can calculate NPV and IRR for all these three situations and you can yourself get satisfied. So again, see, there is two project X and project Y. Can you see project X is generating major cash inflows at the beginning years only. 250 is its initial investment and 2 lakh it has already earned in the form of cash inflows in year 1 itself. Whereas on the other hand, see project Y. Project Y का investment is 3 lakh, but it is generating more cash flow at later period. So in such case, in such situation, again there would be conflicting results. Are you getting this? So again, we will not solve this. You can solve it at your home. You can practice it at your home. We will see just the end result, overall position. Project X. So can you see the overall position? Here there is a mistake. It is project X and project Y. Instead of A and B, it should be X and Y. NPV of project B is more, but IRR of project A is more. You can calculate this and match, and you can check this after the session ends. You can practice at home, but we are more concerned with the end result. We are here to understand the situations, the scenarios. Understood? Any questions till here? Situation 2. At the end of the, yes, if time permits, I will definitely explain you IRR technique. Extra questions on this? See, this topic is just for explaining you the concepts. This topic that we are covering right now, it is just for explaining you the three different situations where conflicting result arises. And to prove that point, they have given the illustration. If you want, we can, chalo, let's solve for third situation. We can solve that. Situation 3 is third situation is when life of the project are different. When life of the project are different. So let's say project A का life is for 3 years, project B का life is for 6 years. So under such situation as well, your NPV and IRR would give conflicting results. So these are the three situations where your NPV and IRR give contradictory results, give conflicting results. Which is situation number 1? Situation 1 is when the size of the project is different. When the size is different. Second, timing difference. One project is generating major cash inflows at the beginning of the period. One project is generating major cash flows at the later period of project life. So timing difference. And third is life. Different life. So these are the three situations that you need to remember where there would be conflicting results between NPV and IRR. Okay? If you want to try it, you can try this now for third situation. This is the illustration number 12. Can you see project A? Life of the project A is just 1 year, whereas life of project B is for 3 years. If you want, you calculate NPV for project A and project B and also calculate IRR of project A and project B and check by yourself. I will give you 5 minutes time for this. आपका रिवीजन भी हो जाएगा एनपीवी एंड आईआरआर का. But please try to solve honestly. Yes, there is timing difference also, but their point in illustration 12 is more about showing you the conflicting result due to unequal life, uneven life. Project A is only for 1 year, so obviously entire cash inflow would be generated in that year itself. So try to solve this honestly, just a 5 minutes of time. Huh? I hope everyone is trying. So NPV of project A comes to around rupees 1,69,643, and NPV of project B comes to around rupees 336,256. Sir, one doubt that the life of the project is when the project is continuing or duration of the project till it's completed. Life means the end of the project. आखिरी साल कितने साल तक प्रोजेक्ट चला, दैट इज लाइफ. Till how many years the project has been continued, that is life. That is one and the same. Now after the project is completed, that is life. Tenure, project tenure is life of the project. Project का tenure is life of the project. 336,256. Everyone is getting this answer. The discounting rate is 12% for NPV. For IRR, you need to take different trials because at 12% NPV for both the projects are positive. So to calculate IRR, your trial 2 should be higher than 12%. Your trial 2 for IRR should be higher than 12% because at 12% NPV is positive. I guess IRR will take much time to go on. Here IRR under this illustration, IRR is coming very high. Huh? So I think for different trials, it will take so much of time. So use the discounting rate of 50% that is given in the illustration so that it gets very quickly solved. How will adjust the sir project A IRR 50% exact correct? I didn't get your question, Srini. How will we adjust the reinvestment risk? See, reinvestment risk is to be adjusted only in case of modified IRR. If question asks you about modified IRR, then only that reinvestment thing will come. Otherwise, just follow the normal process. Sir, why not Kambeshwari's question? Why not take in project in second day? Again, I am not able to understand the question. Can you elaborate what you are trying to say? Why not take in project A? What should I take in project A? What should I take in project A? Okay, last 2-3 minutes and then you can continue at home, but we will come to the conclusion. Because here, since project A is having IR at 50%, there would be many trials that you need to take. 52.22. They have taken up to just two decimals, and you would have taken completely. So, since you have taken for entire decimal, there would be certain difference. Yes, so your gap between 10 and 60 is very huge. So, higher the gap between your trials, less would be the accuracy. Less would be the accuracy. So there would be certain difference. Okay, so let's come to the conclusion. So the point is that NPV of project B should be higher and IRR of project A should be higher. This is what I wanted to explain you in situation 3. Are you getting this? The point to explain here is the NPV of project B should be higher, whereas IRR of project A should be higher, which is true for you all, correct? So the overall position is this, correct? So can you see when the life is unequal, there would be contradictory results or conflicting results. So the three situations where NPV and IRR would give conflicting result is one is size disparity, size of the project disparity. Second is time disparity, timing of the cash flow difference. And third is unequal life disparity. ठीक है, ये तीन सिचुएशन में it would give conflicting results around 50 to 52%, 40 to 45%, somewhere between these two. Understood? Bolo, any questions? Any questions still here? Okay, 40%. Okay, no worries. That is also correct. The point is just to explain you the conflicting results. Yes, correct. Tambeshwari, correct. Okay, let's move ahead in our lives. So next topic, see, one of the situation or one of the reason of conflicting result was unequal life, correct? So to remove that deficiency, there are two methods. There are two methods to bring the life at parity and then to decide whether project A should be selected or project B should be selected. So for that, whenever there are unequal life, to bring the project's life at parity, there are two methods. And by applying these two methods, we can calculate the NPV for both the projects and then decide. So these two methods are, one is replacement chain method. This is just to bring the parity in life of two projects. These methods are used when it is used when it is to bring the life of the two projects at parity at same level, and then you can make an investment decision. One is replacement chain method. This technique or this method is used when the life of the two projects are unequal and we want to bring the life at parity so that we can ultimately decide which project to select. Okay, so let's take an example. There are two projects, project X and project Y. ठीक है. Initial investment for both the project is 3 lakhs. However, both the projects are having different life. Life of project X is just for 2 years, whereas life of project Y is for 4 years. Okay. So let's say my cash inflow for project X in year 1 is 150 and in year 2 is 350. 50,000, 150, 3 lakh and 350. So this is the scenario, and let's take discounting rate by KO is equal to 12%. Now, this replacement chain method says, see, ideally, these two projects are having unequal life. So ideally, you cannot make any decision because this project is just for 2 years, whereas this project Y is to be undertaken for 4 years. So ideally, these projects are not at parity. There is no comparison between these two projects. To make it comparable, to make or to bring these two projects at parity, what we need to do? Can I say this project X, this entire project X, I can undertake one more time so that it becomes comparable with project Y? Yes or no? This entire, see, project X will be ending at the end of year 2. So at the end of year 2, take project X one more time. So can I say at the end of year 2, there would be cash outflow of 3 lakh. I am taking this one more time to bring at parity with project Y, to bring the life at parity with project Y. And my cash inflow for year 3 would be 150 and for year 4 would be 350. Are you getting this? entire project. I'm taking it one more time. Why? To make it comparable with project Y, or to bring the life at parity with project Y. Are you getting this? This is what replacement chain method says. You replace the entire project again. Are you understanding the concept? What this project or what this method is trying to say? You replace the entire project again. Understanding, to bring the life at parity. To bring the life at parity and make the projects comparable. समझ रहा है सबको? बोलो, any confusion here? Very easy. Replacement chain technique says you have to bring the life of the two projects at par. So since project X ka life is 2 years and project Y ka life is 4 years, take entire project one more time. Undertake entire project once again, so that life is equal. So can I say my cash inflow ka stream, if I calculate NPV for project X, my year would be 4, 2, 3, 4. Yes or no? My cash inflow would be 115 year 1, 315 year 2, 115 year 1, 315 year 2, and again I am taking this entire project. Are you getting this? So 150 in year 1 and in year 3 and 350 in year 4. But my year 2 ka cash inflow will be something like this. I have to subtract outflow because I would invest 3 lakh again at the end of year 2. Yes or no? It would be 350 minus 3 lakh. Why? Since I am taking project X again entirely, I have to spend 3 lakh at the end of year 2. Yes or no? So that would be an outflow at second year ke end pe. So I am subtracting that from inflow. Are you getting this? Are you getting this? Or if you don't want to take it with inflow, you can take it separately with outflow as well. Okay? It is your choice. If you don't want to subtract it here, you can take it with outflow as well. You can discount the outflow as well. As if ki second year pe there is additional outflow of 3 lakh. Understood? So my present value, here you write the discounting rate. Here you write the discounting factor at 15%. 15%, no, 12%. My discounting rate is 12%. And then we calculate PVCI. Can you help me in calculating this PVCI? 150 divided by 1.12. 350 divided by 1.12. 150. I hope by now you are able to calculate in Calc. कितना आया बोलो? What is my PVCI? Total PVCI. 742,144. Why take third year 150? I repeating the entire story. Replacement chain method says to bring the life of the project X is 2 years, life of the project Y is 4 years. So as of now it is not comparable because both are having unequal life. How can that be compared? Project X ka life is less, project Y ka life is more. It is not comparable. So replacement chain method says to bring it comparable or to make it comparable. Can I see if I take entire project one more time, entire project X one more time, then there would be 4 years ka inflow, because project X start today, it will end at year 2. Then again at the end of year 2 start and it will end at year 4. Are you getting this? Start today, project X will end at year 2. Again take the entire project for one more time. So can I say year 2, there will be outflow of 3 lakh. एंड ईयर 3 का इनफ्लो होगा, ईयर 4 का इनफ्लो होगा. So you are taking the entire project one more time so that the life is now at parity, life is now at par, and then the project can be compared. Did you understand now? कितना है? 742 719. Please calculate 742,144.79. A discounting rate is 12%. Huh? So my total PVCI comes to 742 150, around 145, something like this. So this is my PVCI. Now calculation of PVCO for project X. When I say year, there would be year 0. Year 0 means at the start of the project I will invest 3 lakh, and again at the end of year through at the end of year 2 I will invest 3 lakh. So year 2 cash outflow would be 3 lakh at 0 point, that is at today, and again I will incur an investment of 3 lakh at the end of year 2. So you will discount this also at 12%, and my PVCO आज का 3 lakh will always be equal to 3 lakh today. उसको नहीं डिस्काउंट करना है. You have to just discount the 3 lakh of outflow at the end of year 2. It comes to how much? कितना आया my total PVCO? Yes, around 742. 239. 239. 239,158. So this is 239,158. So my PVCO comes to 539,158. Correct. So my NPV is nothing but 742,145 minus 539,158. So NPV for project A is how much? NPV for project A comes to how much? 742,145 less 539,158. 202,987. ठीक है? Understood everyone? What we did, we undertook the entire project one more time as if की project X start हुआ आज, it ended at year 2, then I again invested 3 lakh at the end of year 2, and I generated cash inflows for year 3 and for year 4. ठीक है? So I undertook this project again entirely one more time. Why did I do that? To bring the life at par with project Y. Understood? So now second step is to calculate for project Y. I will write down the year 1, 2, 3, 4. Cash inflows for project Y are as follows: 50, 150, 3 lakh, 350. 50, 150, 3 lakh, 350. ठीक है? कितना आया बताओ? I will come to that point, Hardik. I will come to your point. 600187. My PVCI comes to 600187, and my PVCO is 3 lakh, correct? Because it is at the end, at the beginning of the project's life at year 0. So can I say my NPV for project Y, for project Y is nothing but 600487 minus 3 lakh. 3 lakh is the initial investment. So 300487. Now this 300487 can be compared with 202987, and now you can decide which project to be undertaken because the lives are at par. Are you getting this? First, when there is unequal life, you first need to bring the life at parity. Why to bring the life at parity? To make it comparable. Are you getting this? So when the life of the projects are unequal, you need to bring life at parity by using replacement chain method. Now my question to you, see here, I give you very simple example. Life of the project X was 2 years, and life of project Y was 4 years. So it is very simple to understand that if I take this project one more time, then project X का life हो जाएगा 4 years. Yes or no? It is very simple illustration over here. But what if the life of project X is 7 years and life of project Y is 11 years? In that case, how will you solve? How will you use replacement chain method? Bolo. What in this case? Life of the project, see in my current illustration, it was very simple. To एक का life 2 साल, एक का life 4 years. To make it comparable, to bring this 2 years to 4 years, you just take entire project one more time. But under such scenario, when the life of project X is 7 years and life of project Y is 11 years, how to use replacement method? Bolo. How will we do that? Yes, LCM. Then we need to take the LCM. This is not Word document. This is PowerPoint. And in Excel, there is no such feature to write with this pen. I am using a pen to write in the tablet. So in Excel, I don't have that feature. So that's why I'm using PowerPoint. So in that case, we need to use LCM. And LCM here, the common multiple would be 77 years. It means undertake this project X 11 times. Undertake this project X for 7 years 11 times means 7 years completed, again repeat 7 years, again repeat 7 years. This process you need to undertake 11 times. And for project 11 or for project Y, which has a life of 11 years, you need to undertake the entire project 7 times. The common multiple is 77 years. So can I say the calculation will be very complicated and time consuming? Yes or no? Are you getting this? Are you understanding? See, current illustration was very simple, 2 and 4. So just repeat the project one more time. So you will get the life to 4 years. But under such scenarios, when life of project X is 7 and when life of project Y is 11, we need to repeat this project X 11 times and we need to repeat this project Y 7 times to make it comparable. Are you understanding? So can I say calculations will be very lengthy and time consuming? Are you understanding? Are you understanding the logic? And finance managers are very lazy. They are not interested in such time consuming or lengthy process. So they have derived another method for unequal life. To solve the problem of unequal life, they have derived another method. And that another method is called as equivalent annualized criteria. Equivalent annualized criteria. What is the name of the another method? Equivalent annualized criteria. The steps involved under this method is, please pay attention very carefully. Step 1 is calculating NPV for both the projects. This is very simple method. You calculate NPV for both the methods. ठीक है? Very simple. NPV for project X and NPV for project Y. Step 2. Divide the NPV by PVAF factor, present value annuity factor. I hope you know what is PVAF. PVAF is summation of each year's discounting factor. I have discussed this at a very first session of investment decision. Okay? And then compare. Okay? Under equivalent annualized criteria, you just need to follow two steps. And both the steps are very simple. Step 1 is calculate NPV normally that we have learned for both the projects and divide that NPV by PVF factor. Okay? And then compare and then see what is the answer. Okay? So let's take an example of this. Let's take an illustration of this equivalent annualized criteria. So for replacement chain methods, can you see there are two methods to solve the problem of unequal replacement chain method. Replacement chain method means repeating the project again and again. Okay? Repeating the project again and again. Under illustration 4, life of the project A is 6 years and life of the project B is 3 years. So when I say I can repeat this entire project B one more time, so that life of project A and project B will be 6 years now. That is replacement chain method. Are you understanding? You can undertake entire project one more time, so that life of project B also becomes 6 years and now it is at parity with project A. But I gave you one example. What if project A ka life is 7 years and what if project B ka life is 11 years? In that case, the common multiple would be at 77 years and the process would be very time consuming and lengthy. Yes or no? And financial managers are very lazy person. They don't want to spend so much of time. In that case, we use another method, that is equivalent annualized criteria. That is equivalent annualized criteria. And the steps are mentioned for that method as well. See, compute NPV using normal discounting rate. Then you compute PVF factor. PVF factor is what? Summation or cumulation. Summation or cumulation of discounting factor for each year, and then you divide that NPV by PVF, so you will get equivalent annualized criteria. Okay? So let's take an illustration to understand this better. Let's say there are two projects, project X and project Y. Life of project X is 3 years. Life of project Y is 6 years. So as of now, they are not comparable because both are lengthy. If the life of the project would be 7 or 11 years. So in that case, we are following another method. Odd numbers. Okay. उससे कुछ फर्क नहीं पड़ता. But since you have that wish, I will take odd numbers. Life of project X is 3 years. Life of project Y is 5 years. No worries. Initial investment is 5 lakh for both the projects. Cash inflow, the pattern of cash inflow is as follows. 2 lakh, 250, 4 lakh. The pattern of cash inflows for project Y is as follows. 1 lakh, 150, 4 lakh, 3 lakh and 150. My discounting rate, my cost of capital is 15%. Okay? My discounting rate is 15%. Now the question says which project should be selected. So by just calculating NPV, if you decide which project should be selected, then you are absolutely wrong, because both the projects are not comparable as of now, because both are having criteria and decide which project should be selected. So step 1 is calculating not A, and again the pattern, the process will remain same. Year, cash inflow and present value of cash inflow at 15% discounting rate. Again same year, cash inflow, PVCI. Okay? So project A का life is only 3 years. The pattern of cash inflow is 2 lakh, 250 and 4 lakhs. Can you help me in calculating PVCI for project X? Normally जैसे हम कैलकुलेट करते थे वैसे ही. Now we are not using replacement chain method. We are using normal NPV method as of now. 2 lakh divided by 1.15 equal to M plus 250 divided by 1.15 equal to M plus 4 lakh divided by 1.15 equal to 3 times. बोलो कितना आया? What is PVCI for project X? PVCI comes to 739,130. Everyone, are you getting same answer? And what is PVCI for project Y? Please calculate PVCI for both the projects. We have discounted 709,487. My calc is not working, otherwise I would have helped you in calculation. See, for project X, everyone please follow the step. Take 2 lakh in calc, press division sign, enter 1.15 equal to 1 time. So this is 2 lakh का present value. कितना आया? 173,913 something. Yes or no? Why you are not able to calculate simple present value of 5 divide and press equal to 2 times. Again, take 250, 2,50,000 in your calci, press division sign 0.15 and press equal to 2. And for 4 lakh in your calci, press division sign, enter 1.15 and press 625, 263,000, 63,006 plus 180,036 plus 173,913. 625 able to solve simple present value from few lakh in calci. कितना आ रहा है? No, now let's solve for each year because everyone is getting different answers. 86,957. For year 2, take 150 divide by 1.15, press equal to 2 times. कितना आया? 113,421. Now tell me for all the years. 4 lakh divided by 1.15, press equal to 3 times. 63006. I am not able to read the first number. 263,006. Okay. 3 lakh divided by 1.15. Press equal to 4 times. 171,526. And 150 divided by 1.15, press equal to 5 times. कितना आ रहा है? Something 4577. 4577. Yes, 74,577. Now add this. कितना आ रहा है total? How much is the total of PVCI? 09,487. I don't know why everyone was getting different answers. Now from this, if we subtract PVCO, which is initial investment of 5 lakhs. So can I say my NPV for project X comes to 125,955 and for project Y it comes to 209,487. So tell me, which project Y we cannot decide. The life is different. It is not comparable. ये तो सिखा रहा हूँ मैं. This is what I am teaching you. This NPV is just for 3 years and this NPV of project Y is for 5 years. It is not comparable. You cannot decide here. This is what I am trying to explain you since last half an hour. To make this comparable, you need to bring the life at parity. And to bring the life at parity, we have two methods: replacement chain method and equivalent annualized criteria. For the replacement chain method, we are following equivalent annualized criteria method. And as per equivalent annualized criteria method, there are two steps. First is step 1, calculation of NPV for both the project. That is done. Step 1 is done. This is step 1, calculation of NPV for both the projects. Step 2, divide this NPV by PVAF factor. By PVAF factor. Bolo, how do you calculate PVAF factor? PVAF factor is simply the summation or cumulation of discounting factor for each year. So let's write discounting factor at 15%. For year 1, it would be 1 divided by 1.15. Point, take up to 4 decimal. 0.8696. 0.7561. 0.6575. So can I say my PVAF for project X would be summation of these 3 discounting factors? Yes or no? Plus 0.6575. So it comes to 2.2832. So you divide this by 2.2832. So my annualized NPV would be 125,955 divided by 2.2832. कितना आया? Around 75,166 something 51,656. Sorry, 75,166. Everyone? Oh, it is 55. 55,166. Okay. 55,166. See, here it is not comparable. This 125 cannot be compared with 209 because life is different. To make it comparable, we are using equivalent annualized criteria. Again, for project Y, similarly, we will divide it by PVF. See, for project Y, it cannot be 2.2832. We need to add discounting factor of year 4 and we need to add discounting factor of year 5 as well to this 2.2832. 1 divided by 1.15. So for year 4, it is 0.5718 and for year 5, it is 0.4971. 2.2832 plus 0.5718 plus 0.4971. So it comes to 3.3521. The PVF factor for project Y is 3.3521. So my annualized NPV for project Y comes to 209,487 divided by 3.3521. कितना आ रहा है? Something 2494.25. What is the first number? 6. Okay. 62,494.25 and now it is comparable. This is what annualized equivalent annualized criteria says. Now you compare. So now as per equivalent annualized criteria, project Y should be selected. At this point, you cannot decide. At this point, just by calculating NPV, you cannot decide anything. Why? Because the life is different. First, you need to make the life. You need to bring the life method. That area ka meaning. This means कि on an average, my project X will generate 55,166 of NPV each year. On an average, my NPV of project X each year would be somewhere around 55,000. And project Y ka NPV on an average every year would be somewhere around 62,000. Okay, this is how you make the projects comparable when life is different. Understood? So बातों में we have also learned to solve the problem of unequal life using two different methods, replacement chain method and equivalent annualized criteria. Okay? So again, please just by calculating simple NPV, don't make any decision. Don't make any decision. You need to bring the projects, make the projects comparable. And to make them comparable, use the two methods, replacement chain or equivalent annualized. Can I say this is very quick method to solve? This is very quick and time saving process. So in practical world, we use this method instead of replacement chain method. Okay? Last topic of this chapter. Can I move ahead? Can I move forward in life? Everyone clear? Is there any question in the query portal? Okay. So the last topic of this chapter is topic called capital rationing. And here rationing means constraint, restriction or limitations. Capital means funds. Means capital rationing is a situation where company has different projects, many projects, and all the projects are having positive NPV. So as per decision criteria, every project should be selected. Yes or no? All the projects are having positive NPV. So company should take all the projects ideally. But there are fund restrictions. Company is not having money to invest in all the projects. Understood? So in under such situation, how should we make decision? What should be the selection process? Which projects to be selected and which projects are to be ignored? That we will learn now. Are you understanding the concept? What do you mean by capital rationing? Rationing means restriction, constraint. You have multiple projects. You have multiple projects with positive NPV. Project X, Y, Z, A, B, C. All having NPV positive. All are having positive NPV. So ideally, as per NPV's decision criteria rule, all the projects should be undertaken. So ideally, all the projects company should undertake, but company is having restriction in funds. Are you understanding? पैसे की कमी है, बाकी किसी की कमी नहीं है, सिर्फ पैसों की कमी है. So in that case, from this multiple projects, which projects we need to select? That we are learning now. That we will learn now in this topic. Understood? The basic, the learning objective of this topic, capital rationing. बोलो कोई query इसमें? Any questions? Capital rationing. Yeah, it is on page number 7.53. It is on page number 7.53. The objective of NPV is maximization of wealth. However, can you see the first paragraph? However, there may be situation due to capital constraints. A firm may have to select some projects among various. Means all the projects are having positive NPV. But we cannot invest in all the projects. Why? Because पैसों की कमी है. We don't have enough resources. We don't have enough capital. So in that case, how to make investment decision? In that case, which projects to be selected? In that case, which projects to be left out? That we will learn now. So as per capital rationing technique, first of all, they have broadly categorized the projects into two categories. One, where the projects are indivisible, and two, where the projects are divisible. Where the projects are divisible. Hey, what do you mean by the term indivisible and divisible? Anyone wants to try? What is the meaning of indivisible and what is the meaning of divisible? Bolo. Can be divided or not? Yes, correct. Sanya is correct. So let's say there is project X, which is of 3 lakhs. Okay? In both the case. I'm just explaining you the meaning of the term divisible and indivisible here. Let's say there is project X, which is of 3 lakh. But the company has funds of only 2 lakhs. But the company has funds of only 2 lakhs. So if the project is indivisible, company cannot invest in this project. Why? because it is indivisible. लेना है तो पूरा project लो. This is what it means. If you want to take the project, then entirely project should be undertaken. Part project is not possible. This is what indivisible means. If you want to invest in project X, you can invest, you have to invest entirely. You have to undertake entire project X. Part is not possible. That is indivisible. But yeah, divisible means part is possible. If you have 2 lakhs, then take 2/3 of the project. Invest only 2 lakh instead of 3 lakhs. Don't take entire project. Take 2/3 of the project. This is what divisible means. Understood, everyone? Indivisible means if you want to take the project, take entirely or don't take. Either or. Either take or don't take. Here, proportionately you can take under divisible. Are you following? Any questions here? Yes, divisible, able to divide. Indivisible, yes. Independent. Divisible means independent of each other. Correct. Part is possible. Part divisible means part. टुकड़ा possible है. Indivisible means टुकड़ा possible नहीं है. You have to take entirely. You cannot take the part of the project. So here, part project not possible. And here, part project is possible. Understood? So this is what they have explained you. Point number 1 is when projects are independent. Independent means divisible and are divisible in nature. So in that case, a decision making criteria. Now listen very carefully. When projects are divisible and when projects are indivisible. When the projects are indivisible, our selection criteria would purely be on normal NPV. Would purely be on normal NPV. So calculate NPV of each of the projects separately and give rankings from higher to lower. Are you understanding? Give rankings from higher to lower. क्या करना है? Calculate NPV for all the multiple projects and it would be obviously positive. And based on that, you give rankings from higher to lower. Which project has higher ranking? That would be rank 1. Then after that rank 2. Then after that rank 3. जैसे स्कूल में होता था, more marks, higher the rank, less marks, lower the rank. Same situation you have to apply here. Calculate NPV and give rankings based on NPV and give rankings to the project based on NPV. Here, this technique says you calculate NPV per capital rupee invested. You calculate NPV per 1 rupee invested and then give rankings. We will take illustration and we will solve this so that you get better clarity. Here you just need to calculate simple NPV and based on that give rankings. Here you have to calculate NPV per rupee of investment. NPV per rupee of capital invested in the project and then you need to give rankings. This is what this method says. Understood? पहले तो did you understand the meaning of the term capital rationing? Rationing means constraint, restrictions, limitations in funds. Company has multiple projects with positive NPV, but it does not have paisa. It does not have funds to invest. So for that, first we categorize the projects into indivisible, whether they are indivisible or divisible. Indivisible means part is not possible. If you want to take the project, take entirely or don't take. And divisible means part is possible. Proportionately, you can take that project. So under indivisible technique, your rankings of the project will be purely on NPV technique. And under divisible technique, your NPV, your decision making, your rankings would be on NPV per rupee of capital invested. Or you can also use PI technique to give rankings. These both will give same result only. Yeah? Either you use NPV per rupee invested or you use PI technique. Answer rankings under both the scenarios would be same. Okay? So let's take an illustration to understand how capital rationing situation works. And let's solve this illustration 30. Shiva Limited, as of now, do you have any confusion? As of now, do you have any questions for capital rationing as far as concept is concerned? Which previous topic? Equivalent annualized criteria. You can ask once we complete this, because since we are into capital rationing, let's just not break the flow. You can ask once this is completed. Shiva Limited is planning its capital investment program for next year. It has 5 projects, all of which give a positive NPV. So ideally, as per NPV technique, all the projects should be undertaken at the cutoff rate of 15%. Means discounting rate is 15%. The investment outflows and the present values being as follows. See, they have directly given in this illustration the outflows and the NPV. This 15,400, 18,700, 10,100 are not cash inflows. They are net present value only. They are NPV only. So don't get confused over here. कि ये cash inflow हमें discount करना है. No, they have directly given the NPV. Understood? The company is limited to a capital spending of 120. Ideally, all the projects are having positive NPV, correct? So ideally, all the projects A to E, every project should be selected. So can I say my investment would be 50 plus 40 plus 25 plus 30 plus 35? Yes or no? 90, 110, 140, 170, 180. 180 का investment होता ideally to invest in all the projects. Yes or no? But my restriction of funds is up to how much? 1,20,000. So I cannot take entire projects. I have to ignore some and I have to take some. I have to give preference to some of the projects and I have to ignore some projects. So how to give preference? You have to give rankings. And how to give rankings? It will be based on whether the projects are divisible or indivisible. So let's see under this illustration whether the projects are divisible or not. You are required to illustrate the returns from the projects within the period of spend within the capital spending limit. The projects are independent and divisible of and are divisible means part project is possible, means even proportionate spending is allowed. So question में दिया है which projects are divisible means we have to calculate NPV per rupee of capital invested and then give the rankings. Are you getting this? Are you getting this? So let's calculate NPV per rupee of capital invested for each of the projects. NPV per rupee invested. As a project A, B, C, D, E. Project A का NPV is 15,400 and its investment amount is 50,000. So how much is my NPV per rupee? 15,400 divided by 50,000. 0.308. Yes or no? NPV per rupee means 1 rupee of investment is generating NPV of 0.308. This is how you interpret this. 1 rupee of capital invested in the project is generating NPV of 0.308, not cash inflow of 3.308. There is a difference between NPV and cash inflow. Understood? This is how you interpret. For project B, 40,000 is the investment amount. 40,000 and NPV is 18,700. Similarly, for project C, 10,100 divided by 25,000. For project D, 30,000 divided by, sorry, 30,000 is again investment amount. 30,000 divided by 11,200. And for project D, it is 19,300 divided by 35,000. 19,300 divided by 35,000. ठीक है? So can you calculate NPV per rupee investment for project B, C, D, E? And I will then give rankings. Well, project A is generating 0.308 of NPV on per 1 rupee invested. B is generating 0.4675 rupees of NPV on 1 rupees of investment. This is how you interpret this value. 0.404 divided by 30,000. 0.3733. 19,300 divided by 35,000. 0.5514. Yes or no? Is everyone following? Okay, you have solved. So now rankings. Let's give rankings. Can I say project E is generating more NPV on 1 rupee of investment? So we will give rankings. Higher the marks, higher the rankings. Simple. Higher the marks. Project is generating more NPV on 1 rupee of investment. So we will give rank 1 to project E. Project B stood second in the class because it is generating second highest NPV. Project C stood third in the class. Project D stood fourth in the class, and project A stood fifth in the class. So can I say this is the rankings of undertaking the project? Are you getting this? So our rank 1 is to project E. So project E is rank 1. And how much rupees of investment is needed for project E? Can I say 35,000? So we will take entire 35. We will take entire project E of 35,000 because we have sufficient funds. We have 1,20,000 of funds that we need to spend. So we will take entire project T because it is of just 35,000. Next ranking is to project B, correct? And project B हमें कितने में मिल रहा है? Can I say 40,000 में मिल रहा है? Can I say I am able to undertake project B in 40,000 rupees? So I can again take entire project B because I have sufficient funds. I have sufficient funds of 1,20,000. Then project C. Project C, sorry, third rank 3 is to project C, correct? Yes, it is to project C. Project C. कितने में मिल रहा है हमें project C? What is the amount of investment needed for project C? It is 25,000. It is 25,000. Am I able to undertake entire project C? Yes, still I have sufficient funds. See, 35,000 for E, 40 for B. So 75 is utilized. C, another 25. So 1 lakh is utilized. Are you getting this? So these 3 projects I am able to take entirely, and my funds needed for these 3 projects is 1 lakh. Still I have 20,000. Yeah, are you getting this? Still I have 20,000. Still I have 20,000. And project fourth ranking is project D. Fourth rank is project D. And project D हमें कितने में मिल रहा है? The cost of project D is 30,000. But I only have 20,000 of funds. Are you getting this? I only have 20,000 of funds. So I cannot take entire project D. Only part is to be taken. So can I say project D only 20,000 divided by 30,000? I can take proportionately. So can I say 2/3 of the project I can take? Are you following? This is how capital rationing works. Since the projects are divisible, means even if you have 20,000 of funds, so you can take proportionately. You can take proportionate project. You don't need to take entire project. Take the so project EBC entirely to be taken and 2/3 of project D to be taken. Understood? Capital rationing when projects are divisible. When projects are divisible. So under this illustration, they have just asked when the projects are divisible. But we will calculate what if the projects were indivisible. What if the scenario changes? The project is indivisible. So in that case, how to give ranking? In that case, we have to just give ranking based on NPV. In that case, we have to just give ranking based on NPV. Okay? So let's solve that as well. Had the projects been indivisible, rankings would be based on normal NPV. Okay? So again, project A, B, C, D, and E. Project NPV of the project of each of the project. Let's write it down: 15,400, 18,700. See, in this illustration, they have directly given NPV figure. Huh? Students do mistake over here. They consider this amount as present value of cash inflow. They take this as PVCI and then they subtract with PVCO, which is wrong. NPV is given directly. 18,700, 10,100, 11,200, 19,300. So now let's give rankings based on simple NPV. So again, can I say project E stood first in the class because it is having highest NPV? Yes or no? Project B stood second in the class because it is having second best NPV. Now here project A is having third highest NPV. So we will select that. We will give ranking 3 to project A. Project D ranking 4 and project 5 or C ranking 5. So giving ranks is very simple. Higher the marks, higher the ranks. School hai ye. So now let's calculate which projects to be taken. Project E is given ranking 1. So how much of investment is required for project E? 35,000. Okay, I can take entire project E. I have sufficient funds of 120. Then second rank is to project B. So can I say I can take entire project B as well of 40,000? I have sufficient funds. Project B, 40,000. So till now I have utilized 75,000 of 1,20,000 available to me. Now project A is rank 3. Project A is rank 3. How much investment is needed for project A? 50,000. 50,000. Bolo. Projects are indivisible. If you want to take project A, then take entire project. Otherwise, don't take. Bolo. Shall company be able to take project A in this case? Obviously not, because if we take project A, then our total amount needed would be 125. But I have just 120 of funds with me. Are you getting this? So project A, even if it is rank 3, we have to ignore. We have to ignore. Okay? So then go for another project. Project A is ignored, then go for fourth ranking project, project D. Project D. How much fund is needed for project D? कितना पैसा चाहिए? 30,000. Can we take project D entirely? Yes. 35 plus 40, 75 plus 30. So 1,05,000. Yes or no? I can take project D. And rank 5 is project T. For project T, how much fund is needed? Rank 5 is project C. So for project C, 25,000 is needed. I have already spent 35 plus 40 plus 30. I have already spent 105. So when projects are divisible, either take entire or don't take. Yeah, remaining 15,000 only. So we will not be able to take project C. Understood? Are you getting this? How you solve when projects are divisible and when projects are indivisible? Everyone followed? Don't take if indivisible. Correct. Indivisible says if you want to take, then take entire project. Otherwise, don't take. So in indivisible, we can take in indivisible में fully लेना है. We don't have any option. Indivisible means either take entire project or you don't have any option. You have to ignore that project. This is what indivisible means. Part is not possible. As per indivisible method, part is not possible. Either take entirely or you just ignore and look for another projects. Okay? What we will do with 15,000? We will evaluate project F, project G, project H, project I. We will look for another project, or we will find some projects which are divisible. Understood? We will look out for some projects which are divisible and we will invest in that project, or find some project, another different project G, project X, project I, project J. Look for that. This is what we will do. Understood? So with this, we complete all the topics, all the concepts of capital budgeting. We started with different techniques. There are 7 different techniques: payback period, discounted payback period, accounting rate of return, IRR, NPV, profitability index, and modified IRR. 6 techniques we understood in previous 2 sessions. In today's session, we started with modified IRR. First concept that we learned today was modified IRR. Second, after that, we learned different situations where NPV and IRR would give conflicting results, contradictory results. Those situations are size disparity, time disparity, and life disparity. Third concept we saw: to solve the problem of life disparity, when the life of the project is unequal, we can use 2 methods: replacement chain method and equivalent annualized criteria method, and then make the projects comparable. Okay? After that, we understood the last concept of capital rationing technique. Capital rationing means there are multiple projects with positive NPV. So ideally, all the projects should be selected, but you have lack of funds. You have funds restriction. Explain block of assets. That is a taxation part. Block of asset you have learned in direct taxation. Block of asset means assets under a block means all the assets that fall under same rate of depreciation. That is block of assets. Let's say there are 5 different machineries which falls under 15% block. There are other fixed assets which also fall under 15% depreciation rate. So both are said to be block of assets. That is a part of taxation also. You would have learned this in direct taxation. Any questions? Would you want to solve illustration number 17 because it covers all the major techniques. Illustration number 17 of module. It will help you in revising all the techniques. See, they have asked payback period, they have asked NPV, they have asked profitability index, and they have asked IRR. NPV and profitability index is very simple. NPV is PVCI minus PVCO. Profitability index is PVCI divided by PVCO. So would you want to try this question? We have 5 minutes ka time. At least we can solve NPV and IRR. At least we can solve that. Payback period is very simple. And PI index, if we are able to calculate NPV, then PI index is left hand task for us. दाएं हाथ का खेल है. So let's at least try NPV and PI index. Sorry, NPV and IRR. किसी का डाउट था ना, they want to revise IRR, so let's solve illustration NPV or illustration 17 and calculate NPV and IRR. We'll just calculate these two things. Discounting rate is 10%, which is given in the question. Plus discounting factor is also given. So you need to take this discounting factor only. Don't question a question. If they have given up to 3 decimals, use 3 decimals. So working note 1. Calculation of PVCI. Year, cash inflow, discounting factor at 10% and PVCI. What is the life of the project? It is 10 years. I think you can try this on your own as well. 9 and 10. Cash inflows 14 lakh up to 5 years. 16, 20, 30. 8, 20, 30, 20, 16. 8, 20, 30, 20, 16. Correct? 8, 20, 30, 20. And for first 5 years, it is 14 lakhs each. Discounting factor are already given in the question. Huh? So use up to 3 decimals only. Whatever is given in the question, use that only. 0.909, 0.826, 0.751, 0.909, 0.826, 0.751 and so on till year 10. Okay? So tell me this last figure, PVCI. सब मल्टीप्लीकेशन करने के बाद, सब एडिशन करने के बाद, व्हाट इज माय पीवीसीआई कमिंग टू? What doubt you have, Hardik? Rest all you can try to calculate PVCI. Check with solution as well. Should come to 97, 70 to 200. Your total PVCI should come to 97, 70 to 200. I don't have right of unmuting. I'm not able to unmute. You can write on the query portal or you can type it here. See, NPV is the ultimate logical method. So you have to choose as per NPV method. MIRR is ideally, I would say, more logical because it uses the reinvestment assumption as well. But as per different methods and selection of the best one, you use NPV method. NPV also has reinvestment assumption. NPV technique also assumes investment of cash inflows at discounting rate. So that is more logical. For MIRR, they would definitely give KO because reinvestment has to be done at discounting rate or the desired rate. So without that, MIRR is not possible only to calculate. Without having KO or without having information on minimum rate of return or desired rate of return, you cannot calculate MIRR. So PVCI, everyone 97, 70 to 200, a yes or no? Less PVCO. Project cost is the project cost 80 lakhs. When I say my NPV at 10% is positive. So NPV at 10% is positive. So as per NPV technique, we should accept the project. 1770 to 200. As per NPV, since NPV is positive, we should accept the project. Now at 10% NPV is positive. Now we want to calculate IRR. And IRR is that point where NPV is zero. Correct? IRR is that point someone had asked me to quickly revise IRR. So please pay attention. I am quickly revising IRR. IRR is that point where is that point or that discounting rate where NPV is zero. So we just now calculated at 10%. At 10%, NPV is positive 17 lakh 7200. So that cannot be my IRR. IRR has to be that rate where NPV is zero. So can I say I have to bring my NPV from 17 lakh 72,200 to zero? I need to fall my NPV. So to bring down your present value, we increase the discounting rate. And another hint is directly given in the question. Another hint is that if you see the table, they have given discounting factor at 15%. So IRR would definitely be between 10 and 15%. Otherwise, they would not have given discounting factor at 15%. Are you getting this? This is how you use the hint from the questions. So trial 1 is already done. Trial 1. When KO is equal to 10%. Our NPV came to 17 lakh 72,200. Now let's calculate NPV at trial 2 when KO is equal to 15%. So in that case, NPV should definitely be at negative side. You can calculate at home. I'm just taking the NPV figure from the solution. So at 15%, my NPV, can you see in this page 7.6 is NPV comes to minus 1,16,000. Yes or no? So to calculate IRR, we use interpolation. And from that interpolation, we have derived a formula. IRR is equal to lower rate, lower discounting rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate multiply by higher rate minus lower rate. This is how we have devised the formula using the logic of interpolation. Correct? So my lower rate here it is 10%. My lower discounting rate is 10%. My NPV at 10% is 17 lakh 72,200. Divide by NPV at lower rate. Again, it is 17 lakh 72,200 minus NPV at higher rate. Higher discounting rate is 15 and NPV at 15% is negative 116. Here students make mistake. They don't write the negative sign. Minus 116. So be careful over here. Multiply by higher rate which is 15 minus lower rate which is 10. ठीक है. So इसका आंसर कितना आया 1772,200 plus 116. बोलो कितना आया टोटल. Because you would have not used 3 decimals, you would have used entirely. और सिर्फ 80 का फर्क आ रहा है ना. कितना फर्क आ रहा है 200 रुपए का फर्क आ रहा है. There is only difference of 200 rupees, so that's fine. That is not a big deal. 14.69%. So this comes to 4.69. Bracket का value comes to 4.69. So my IRR is 14.69%. And how do you interpret IRR? Maximum earning capacity that project holds. Means beyond this rate, project will not be able to generate return for you. So if your desire, if your requirement is above this rate of 14.69%, then don't go for this project, because maximum earning capacity of this project is only up to 14.69. उसके बाद इसकी कैपेसिटी खत्म. So look out for other projects. This is how you interpret IRR. Everyone followed? So with this, we complete concepts of investment decisions. We have revisionary lecture on this investment decision again on 12th of November and 19th of November. We would solve some practical problems in that revision lectures. So as of now, any queries, any doubt? NPV is positive. We should purchase the machine. We should go for the project. All of you, shall we end today's session now? Nancy Hingu had a question, what to do in PI? See, in that capital rationing method, instead of NPV per rupee of capital invested, you have to calculate PI. PI means profitability index. And how do you calculate profitability index? It is nothing but PVCI divided by PVCO. Okay? And after that, let's assume we have calculated this PI for all the projects. Let's assume we have calculated PI for all the projects. After that, give rankings. And rankings यही आएंगे. Project E would be rank 1 in that case. Project B would be rank 2 in that case. Project C would be rank 3. Project D rank 4 and Project 5 rank 5. Project A rank 5. NPV per rupee of capital invested or PI gives same ranking only. They would both give same ranking. 1792. So you would have done some mistake in calculation. You can recheck with the solution and do it one more time. Okay. So everyone, thank you for your participation. Practice, revise the capital budgeting techniques, revise all the concepts, and you can attend the revisionary lectures as well.
Recording stopped.
By the way, Happy New Year to you all. We have New Year tomorrow as far as Gujarati calendar is concerned. So have a wonderful year ahead.